In our next journal entry, Cleanmore Appliance is going to sign a $600,000 12% 3-year notes payable with Aberdeen Savings Bank. Under the terms of this repayment, they are going to make quarterly payments of this loan of $50,000, which will go towards the principal balance of the loan, plus additional interest charge. We need to record the journal entry to put this notes payable on our books, and then, just like we do with the mortgage, we have to go to the amortization tables tab and make our amortization table for this note. But let's start with the journal entry. This is happening on January 2nd. The entry, as you've seen by now, to sign a note and receive funds for signing that note, to take out a bank loan, if you will, is always a debit to cash over the credit to notes payable. And it is for the face value of the note, which in this case is $600,000. Take that there, and this is equal to that amount as well. And we have our journal entry. We just need a description. We can say that we signed Aberdeen note. Well, now that we have that note on our books, we're going to have to repay this. And again, as we're going to repay it, we're going to repay $50,000 towards principal each time, plus an interest charge based upon how much we still owe on that note. Our interest charge is therefore going to change with each and every payment that we make, because the principal balance will be getting lower and lower and lower. To make things easy on our accountants, we should prepare an amortization table for that particular note so that people can go and they can reference. And as we see, our first guy that we have up here is our notes payable amortization table. Has 5 columns. The beginning balance, the principal amount that was due at the time the payment is being made. Principal payment, the portion of your payment that is going towards principal. Interest expense, the interest expense that you have to pay in addition to that principal repayment. And then your total payment, the actual in total physical amount of money that we're going to have to hand over to Aberdeen Savings. And then lastly, our ending balance, what we're still going to owe after we make the payment. So beginning balance is what we owe at the time before we make the payment. Ending balance is what we owe immediately after we make the payment. And we're going to start with a row for January 2nd, 2023. What are we going to put into this row? Well, at this time, this is when we're putting the note on the books. And we did that right here in the journal entry. We said we owe $600,000. Since ending balance is what you owe at that time, after all payments, which we made none yet, are accounted for, that's the number that we should start with as our ending balance. So for your amortization table for a note, for the time of signing, all you need to do is fill in the amount that you have listed on the journal entry that you recorded the signing of the note with. Whatever you end one period with is what you begin the next period with. It makes sense that if we owed $600,000 on January 2nd, we're making our first payment on January 31st, but we've not made the payment yet, that we still owe that same $600,000. So your beginning balance is always equal to your last known ending balance. We came up with a structure for the repayment of this note where we have agreed, according to our information, to pay $50,000 towards principal every time, plus an interest charge. So our principal payment on here for our first payment is going to be that $50,000. Well, what amount of additional interest are we going to have to pay on top of that $50,000 towards principal? It's found by using the interest formula of principal balance at the time you're making the payment times rate times time. So if we go back over here, we know that our principal balance at the time we're making this payment is $600,000. The rate stated in here is 12%, but it's 12% for the year. And since we're making a quarterly payment, we need to multiply that by time, which is 1 quarter. So I can figure this out with a formula that my interest expense is always equal to my beginning balance times the stated rate of 12%, so 0.12 times time, which is 1 quarter since it's a quarterly payment. And that's going to math out to $18,000. So we are paying Aberdeen $50,000 in principal, plus an additional $18,000 interest charge as their way of making money as a bank. In total, we're going to have to fork over $68,000. So total payment is just the principal payment plus the recognized interest expense of $68,000. What are we going to owe them at the end? are we going to reduce the amount we owe them by $68,000? And the answer is no, because not the entirety of that $68,000 payment is going towards principal. Only $50,000 of principal is paying off our actual debt. So your new ending balance is always your last known ending balance minus the portion of your last payment that went towards principal. Yeah, we gave them 68 grand, but only 50 of it went towards principal. Since we owed them $600,000 and only 50 went towards principal, we now owe them $550,000. Rinse, repeat all the way down the table again. And again, because we use little formulas like equals this cell, etc., we can make use of the fill handle. When you first do this, you're going to get some craziness like this with a bunch of zeros because you don't have anything in here as a reference. So don't worry, it's going to fill in by itself in a second. Now we fill handle in that whole column. What about our principal payments? Well, we said that each and every time we pay you for the next 3 years on this note, we're going to give you $50,000 that goes toward principal, which means this is going to be consistent all the way down. I typed it in, so when I fill handle, it's just going to copy that number down to every spot. We got $50,000 everywhere. Interest expense is always going to be equal to the beginning balance times the stated rate, and since they're always quarterly payments, times 1/4. So here our formula was cell B4, the beginning balance, times the stated rate of 12%, times that 1/4. Well, since I use a cell reference, when I fill handle, it's going to keep the 12% every time. It's going to keep the 1/4 every time, but it's going to move that cell reference in the way that I want it to. If I bring this down just one spot, we'll see that now it uses cell B5 as our first cell in the input. It's basing this interest payment on our beginning balance, which was $550,000 for that payment, reducing our interest expense to $16,500. And that should be the trend. Your interest expense, when you have this declining payment schedule, should always go down each and every time. And so should your total payment. Again, we use cell references over here, C4 plus D4. So when I fill handle, it's going to move it down, and it's going to change it to C5 plus D5. And again, our total payment went down to declining payment schedule. For our ending balance, it's always going to be the number above less the number to the one towards principal. So if I fill handle right here, we should work out, and it makes sense. We paid $550,000. We owed $550,000. We paid $50,000 towards principal. Now we owe $500 grand. So if you set this table up correctly, at this point we can just go and do this. And yes, there's going to be a bunch of blanks until I get to the very end, in which case all of our numbers are going to work out. They all popped in here. We're going to know that we're correct. Again, I gave you the full table for the life of this note, which means when we're done paying it and we make our last of our 12 quarterly payments, we should be out of debt. And we see right here we have an ending balance of 0. So what is the total amount that we paid towards principal? Well, I'm hoping that it's going to math out to the $600,000 that we owed, because the amount that you originally owed plus one towards principal should be the same amount. So equals the sum, open a parenthesis, highlight all the columns, close the parenthesis, hit enter, of 600,000. And since we want to find the sum of this column and the sum of that column, we can just fill handle across now. And we see that over the life of this note, we are going to pay Aberdeen a total of $717,000. $600,000 of it is going to go towards principal, which was our original balance, plus an additional $117,000 in recognized interest. After we make all those payments, we're going to have a debt of 0. We will have paid off our note. Again, same jam as before. I can't stand when there's extra dollar signs in there. I would never take points off from you, but for me, I'm going to go to the comma style, and I'm going to change it to get rid of them so it looks prettier. That guy should have a dollar sign. We can put him in here with a dollar sign. There we go. So now we have our note payable amortization table scheduled. Every time we make a payment on here, whatever accountant is doing it can go look at the schedule and say, take a date here. I'll say they're taking it on March 31st, 2024. They can say, okay, when we make that, we're paying $50,000 towards principal, so we need to reduce notes payable by that much. We are paying $12,000 towards interest expense, so we get to record that amount of interest expense. And our total payment is the total amount of cash that we're going to surrender. We need to reduce cash by that much. So we have all of our points set up for us, We did it once right at the beginning. Now we have a reference point for the next 3 years, which we can always figure out what every journal entry should be for the note. Next up, we're going to take on one alternate form here of long-term debt, and that is a mortgage. A mortgage typically is centered around buildings, but by definition, it means that you are taking on debt, but instead of getting cash for taking on that debt like we did above with the note and the bonds, you are taking on that debt to specifically acquire one asset. And our asset is going to be a production facility with a market value, a total payment value of $4 million. How are we acquiring this? Well, we're going to acquire this facility by making $1 million cash down payments, and then the remainder, or $3 million that we still owe on this, instead of paying it now, we're going to sign a 6% 20-year mortgage with Legacy Loans for the remainder. Legacy Loans has gone through, they've done all the numbers based upon all of the interest rates and time, etc., and they've determined that our monthly payment to them is going to have to be $21,492.93 each and every month. That's the amount of cash we're going to have to surrender each and every month. Just like before, in addition to recording this journal entry to put the building on the books and put our debt on the books and reduce our cash by the amount of our cash down payment, we should go and we should set up an amortization table. So on January 2nd, let's put the entry to put the stuff on the books first. What are we acquiring? We're not getting cash here. We're doing this for the purpose of acquiring that production facility, which I'm going to book under buildings. We're going to put that on at its market value at the time we're acquiring it, which is $4 million. And our credits are going to be to how we're financing the acquisition of this building. And how we're financing it is we're giving them $1 million cash down payment. So let's reduce cash by $1 million by crediting it. And then the signing of a mortgage is payable for the difference, for the amount that we're not paying for up front. Since it's a $4 million building and we're only paying $1 million up front, we owe them $3 million now. And we can say that we signed a mortgage with Legacy. Let's go back to our amortization table because we're being asked to make it for this particular example. And that guy's going to be down at the bottom. And I'm going to scroll right down to the note on the bottom that I have left you folks. I am only asking you to do this amortization table for a short period of time. In real practice, you would fill it out for the entire life of the loan. This is a 20-year mortgage. We're paying monthly, so we're paying 12 times a year for 20 years. Which means in full, if you're going to actually practically make this amortization table, which you would have to if you were an accountant, you'd have to have it 240 lines tall, 20 years times 12 payments a year. That seems a little excessive for an assignment in a 100 level accounting class. And if you know how to do it for 15 months, you can do it for the whole amount of time. So we're just going to do this until the end of 2024, or to the end of the first quarter of 2024. And I did that on purpose because on your financial statements on your balance sheet, we're going to separate the portion of your mortgage which we have to pay in the next year from the portion that's going to be due more than a year in the future. So this is as far as we have to go to have all that information that we're going to need. Just, again, want you to know that it's not like you can only do a few lines. You should do the table for the entire life of the mortgage. So how are we going to set this up? What are our columns? Just like before with our note, we have ending balance and beginning balance as our bookends for our table. Beginning balance is the amount that is owed at the time that you're making the payment prior to making the payment, or beginning balance, excuse me, is the amount that is owed at the time that you're making the payment prior to making the payment, and ending balance is the amount that you will owe after you make the payment. You have the portion of your total payment that goes towards principal and the portion that goes towards interest, and those two together should add up to the total payment. So what is the first line? Again, we put the amount that we put the mortgage on the books for as our ending balance on the date that we signed the mortgage. So on January 2nd, 2023, when we signed the mortgage, if I hit equals in this cell and go back over to our journal entries, our mortgage is for $3 million. I can knock out something really easy on the second row all the way through. This is a fixed payment mortgage. Most mortgages are, which means the bank tells you this is exactly how much you have to pay each and every month. It's how auto loans work. It's how most loans work. And they've told us that we're going to have to pay $21,492.93 each and every month for the life of this mortgage according to this payment schedule. So on our amortization table for this mortgage, our total payment has to be that $21,492.93. And we know that we're going to pay that each and every month, so I may as well just knock that out right now and Phil handle that the whole way down. Again, getting rid of these ugly dollar signs. All right, so what we're really figuring out here is for each one of those payments, what portion is going to go towards principal and what portion is going to go towards interest. But we need to know how much we owe on the mortgage at the time that we're making the payment. Your beginning balance is always equal to your ending balance from the prior period. It is $3 million. The way to do this is firstly figure out what portion of this payment is going towards interest. And you find that with the standard interest formula, which is principal balance owed times rate times time. We know our principal balance owed at the time on January 31st, 2023, when we're going to make our first payment, is $3 million. What is the rate? Well, the rate is 6%. And since these are monthly payments, then that 6% is for a year, we need to multiply again by the portion of a year, by time that it's going to pass before we make the payment. Since this is monthly, it's 1 out of 12. So on the amortization table, we're going to have this be equal to the beginning balance, clicking on SL, times our 6%, 0.06, and since it's a monthly payment, times 1 out of 12. That comes out to $15,000. So what we are saying is when we make our first payment at the end of January, yes, we have to fork over $21,492.93 to our lending institution that we got this mortgage, we signed this mortgage through, but $15,000 of that is going to go towards interest. Well, what's left over for principal? That is your total payment minus your interest expense. So $21,492.93 minus $15,000 equals $6,492.93. People, just a quick pause right here. People look at that and they're like, that can't be right. I have this huge payment and only this little chunk of it is going towards principal. And regretfully, I'm going to inform you that it is correct. If you take out a long-term loan, like a loan that you're going to take years and years to repay, be it a house, be it your student loans, I assure you in those first few years, your payments are going to be weighted that way. Like it's going to be a huge interest charge versus a small amount that's actually going towards principal. The good news is that every time that you pay, your principal balance goes down. And since interest expense is based on your principal balance at the time you're making the payment, it means less and less is going to go towards interest each year, and more is going to go towards principal. So what is our ending balance? We owed $3 million at the time. I'll use this guy. We paid a total of over 21 grand, but only $6,492.93 of that went towards principal. So if we owed $3 million and we paid roughly $6,500 towards principal, well, now our debt is going to be $2,993,507.07. If we called up our bank at the end of January and said, we want to pay this off now, what do we owe you? That's the number that they're going to spit back at us. So what do we do for the rest of the table? We fill in. Our beginning balance is always going to be the same. We have a cell reference set up where it's always equal to the last known ending balance, as we see here. That works out like that. Our principal payment is always going to be found by subtracting out our interest expense from our total payment. So we want that formula to continue all the way through. And we got the full amount now because I don't have any interest expense showing in these columns, but I will pretty soon. So if I drag that down here, I get this. And then lastly, if I drag down ending balance, it's going to fill in my whole table. To make sure that you're working in the correct direction, there are a few points that you can look at to make sure you have the right trend going on with your numbers. And that is namely, your ending balance has to be going down. If your ending balance is going up, something is seriously wrong. No one has a loan that they pay on and they're more in debt. Like no one wants to be in that spot. And then for every payment that you have, the amount of that payment, which is fixed, that goes towards principal should be increasing. And the amount of that payment that goes towards interest should be decreasing. And again, the reason for that is interest is always based on the last known balance that you had at the time that you made a payment. Well, that's always going to be going down as we get out of debt. So since the amount that we owe is going down and interest is based upon that amount that we owe, that should also be going down. And now, again, we have our whole chart set up for people to reference in the future. Anybody can go through and look at this, any accountant on our staff, and know, okay, this is the total amount of payment that we have that I'm going to have to reduce cash by. This is the amount that goes towards principal. I'm going to reduce our liability by the amount. And this is the amount that goes towards interest. So I'm going to book an interest expense for that amount.